Okay, welcome you all with Get Me Trained Institution. This is Shivraj, and as we discussed on LinkedIn, I would like to take short session on the journal entry for the purchase of marketable securities. Here, that will be clearing two doubts, which is one would be the what would be the accounting entry for a trade date, and another would be the what would be the accounting entry for a trade settlement date. And I'm sure after done with this 15 or 20 minute of session, so we'll have a clear idea about it, what would be the accounting entries for these two different dates. Here we'll discuss with the fact or the accounting standards, what the investment accounting standard says about the two different dates. Okay, so let's start without wasting a time. So here we will go through this, PDF, and even I'll share this PDF to you all so you can read this and you can save this PDF with you for a uh, you know uh, future reference as well. So because this is like very hot topic even for today, because most of the fund managers, they are asking questions on this particular area, and that is what I would I'm taking or hosting this session on this particular key aspect. Okay, so let's then go through it. So journal entry for the purchase of marketable securities. Okay, when market securities are purchased and marketable securities account is debited and cash is credited, the transaction is recorded at cost, including any brokerage commission paid to acquire these securities. Okay, and the journal entry will be made as follows. So this would be your accounting entry. So here, instead marketable securities, you may expect name like shares, maybe bonds, or maybe other preference shares. Okay, this entry would be for purchase trade, right? When you purchase something, suppose you are working for a JP Morgan, and the JP Morgan purchase something, or they have purchased the securities from the State Street on cash, right? So when they purchase something on cash, or let's say they have purchased the securities on cash from the State Street. So in that case, so when we apply the accounting rule here, the golden rules of accounting here, the securities, it means it's your asset or it's a real one, and it when you see the rule for a real account, debit what comes in, credit what goes out, and that's what we have took the securities as a debited, and cash again it's a part of the real account, and that is what it would be credited here. The cash account is credit and the securities account is debit. The price would be, let's say, this is how we prepare the accounting entries. Then what would be the accounting entry for a sell? It will be exactly, reversed. The cash account debit to marketable security account credit. This is how the accounting entries will be prepared. Okay, let's say we'll take this example. Fine company purchase the security shares of Eastern Company for a short-term investment at the rate of this per shares on December and it will also pays a brokerage commission of $100 for the purchase of the securities. So in that case, here, see, if you go through with the above one, so what they have mentioned about the marketable securities, the marketable securities account is debited when they purchase, cash is credited, and the transaction recorded at a cost including the brokerage commission paid to the acquire the securities. Why? Because brokerage, when you pay the brokerage or commission to someone else to make this deal happen, so it means that would be the expenditure for that particular deal, and that should be also included in the transaction or the recording of that entry or accounting entry for that particular trade. So let's see, we have this example here. So in this particular transactions, we're gonna charge $100 as a brokerage commission or fees for this particular deal. So now here that it is required to prepare the journal entry to record the purchase of the shares. Okay, so let's discuss about the solution. So what would be the entry? Market securities. See, the market securities, this one, because this is a purchase entry and this is a cash one, so this says, and why, so here this see, the total purchased 5,000 shares of a Esting company, total cost. How can we calculate the total cost? It means it's acquisition value or purchase value, so how much that you're gonna pay, correct? So the shares into the price plus the brokerage or the commission that we have paid, that will have to add. And once you do this, you will have a cost around 2,27,600, right? And the per share cost would be, if you divide to this amount 2,27,600 by this quantity, they will have a per shares. Okay, and this would be your the accounting entry, and this accounting entry would be in the books of fine company as per the example. But how can you relate to the fund accounting part, maybe your trade processing part, maybe the other, where you are working with that particular XYZ company? Let's say you're working with the any hedge fund house. Let's say XYZ hedge fund house is there and you're working with them, XYZ fund. And that fund purchase the securities. Purchase the securities. In that case, so it will have a same accounting entry in your books of account. But generally, what we do when the hedge fund managers or mutual fund managers, they purchase something, just we add that particular transactions into our internal accounting platform. That's it. We don't do anything apart from it. But for your kindly information, when you add something to the system as a sell trade, purchase trade, as per their asset classes like equity, ABS, MBS, any other contracts and all, when you add that, so they actually create accounts or facilities, or there any kind of such a accounts where you can record all the trades and transactions under that particular deal name or facility name. But once you add it, the system will actually prepare the accounting entry at the back end, and it will looks like this. And that is what at the front side of that particular applications, our core or main job is to just the add that particular transaction. Okay, and okay, so here we're done with the accounting entry. But as the notice that here, for the cost which was this has been computed after the adding the brokerage commission 100 to the total cost of shares, 2,27,500. This per shares cost basis will be used to calculate any gain or loss at the time of sell of the shares as well. When you sell the securities, then only we can compute the gain, whether would be loss or gain, whatever it is, then we'll be able to calculate that. Otherwise we won't be able to calculate, and even we don't have any accurate that the profit and loss information about that particular transaction as well. Okay, so go ahead with that. Marketable securities account is a control account. Which account? Is a control account. For instance, if fine company purchase shares of another company and it will record a similar entry, marketable securities will be debited and cash will be credited. A marketable securities subsidiary ledger account so will, however, be required to keep the records of the securities of each company. Okay, so the main important is when you purchase something, when you sell something, sell or purchase should be your control account. Or the name of this, there would be allocations you may expect for a different financial instrument. One would be for a security or maybe for a common stock. Another would be for a bonds. Then would be for a ABS, asset backed securities, mortgage backed securities, and many more. And under that you can just record the purchase trade and sell trade. The same treatment would be for all. When you purchase something you can add, when you sell something you can add all the inner data, you can add up to this. And that the security account, security means in this case the common stock would be your control account, right? So you can control all the data. The bonds would be again control account or principal account you can call. And but under that the purchase and sell would be your subsidiary account, because these are the sub account, because we'll prepare the sell account or purchase account as well, because we all are aware about the accounting terms as well, or the I would say the final accounting, right? The ledger, sub ledger, main ledger, we all are aware about it. I'm expecting that. And this is how the accounting, that the this particular thing work. Okay, so again, so very important is about trade date and settlement date. So the above portion was for when you purchase something there would be only one entry, and when you sell something there would be again one entry. But apart from that, if you pay something, brokerage charges or anything, that also will have to debit from the amount of that particular trade, so it will be debited eventually. So that you can add, but we'll see that below. Okay, so that was like generic entry that you may expect, the marketable securities account debit to cash. But yet we haven't discussed about would this be on a trade date or would this entry be on a settlement date, right? But that we'll see here below. Okay, so when accounting for the trade date versus settlement date, when accounting for the initial recognition of investment securities, this is important, this is one of the accounting concept. There are concepts like business entity recognition, matching, revenue. There are many more concepts. The same way, the one of the concept is initial recognition. This is important from an interview perspective as well. You may expect questions on as per which accounting concept we do prepare the accounting entries for a trade date and for a settlement date. Okay, so this one is very important. Okay, then there are two critical dates to consider. One is trade date and the another one is settlement date. So what is the difference then, and why are these dates important in this blog? So let's take a closer look at the trade date versus settlement date accounting. Accounting for investment securities. Okay, so there are two main financial accounting standards, and that the codification topic that covers accounting for investment securities accounting standard 320, very important, that defines right? For a investment index, that's investment in securities, and the covers the again for investment in debt securities, while accounting standard 321 covers the accounting for investment in equities. That's two accounting standards are very important from an interview perspective as well. If you are looking for any reporting interview or any product control, or maybe if you're looking for any finance control interview, or maybe for a fund accounting interview, so you should know about this accounting standards or code as well, because you may expect question on this. That is what this is a very important. And here also gap should be also applied. We will focus our attention on the initial recognition of investment securities within the scope of accounting standard 320 and accounting standard 321. Okay, both provide clear guidance on the subsequent measurement and accounting for debt and equity securities, but this is very important, are generally silent regarding the initial recognition. Initial recognition means to recognize the value of a particular thing at the initial stage. So it means on a trade date. Okay. So on a TD. So this is where the issues of a trade date and settlement date comes. Trade date security is the date the agreement is entered into, where element of a transaction including the security description, quantity, price, and delivery terms are set. The trade date, the securities must be delivered and payment received is referred to as the settlement date. Generally, investments are initially recorded on the balance sheet at fair value. This is also important. Fair value, it means actual value, right? If you recall, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This is also important, okay? Why important? Because see this activity to receive something or to pay to transfer. So on which date this happened? On a trade date, right? Okay. The distinction between the trade date and settlement date is an important one, as the initial recognition of security is different under the trade accounting versus settlement date accounting. So now we'll take an example to discuss in details. On March 1, the Baxter company purchases the securities 10,000 of securities of a Tesla for a 600 per share. In accordance with generally established the exchange regulations and conventions, the trade settlement 2 days after the trade order is submitted. Trade settles 2 days after the trade order is submitted. If we want to purchase the securities on a first day, what do? We do create a order that you want the securities of a Tesla for the price of rupees 600 per share, right? So it means we provide that instructions to the broker, and the broker reach out to the custodians, and custodians, they can change the ownership of that particular securities in the respective demat account, and they provide the confirmation to the broker that the securities have been transferred, or the ownership of the securities have been transferred, right, to the respective counterpart. And once they get a confirmation, broker confirm that with their client or the buyer and seller accordingly. Okay, and even for your kindly information, the demat account will be with the custodian, and the brokers are entitled to maintain the trade account only. Okay. Okay, the trade settles 2 days after the trade order is submitted. So this criteria is what this happened on a trade date actually. Okay, on the settlement date, the fair value of a Tesla is when you have submitted the order for a Tesla, the price was around 600 for purchase, and now the price is around 575 because the market is volatile, right? And this may happen at any point of time. Price may go up or go down. That is what we have a system, okay, or we have a process. If the price goes up, if the price goes down, how can we settle the trades or how can we process the trades? That is what we submit the price quotation as well, that the limit price and the market price. The limit price, it means that you can select so any of the price from that particular spread, and the market price, which is something. So if we can select the market price, so it may go the higher price, and even the broker can book the trades or the exchanges may book the trades at a higher price. Okay, it was like this is for an additional information that just you need to know. That's it. The security is in this example is an investment in equity. This is important. Okay, under the accounting standard 321, if accounting is done based on the traded basis, the following entries would be recorded. This is important. Okay, so this would be your accounting entry on a March 1st because it's a trade date. So accounting entry would be investment in equities, would be around this because I think we have purchased this, right? This 10,000 into 600. 10,000. Okay. 10,000 into 600. So value would be, but the very important is here. So in the above at the top, what we have seen, when you purchase something on a cash, the accounting entry would be investment in equity securities account debit to cash account credit. When you purchase something, correct? Purchase something. And here, if we follow the rule of a trade date, so accounting entry, we are processing like when we purchase something on a credit. When you purchase something on a credit, it's like bill payable or bill receivable. So here, so bill payable, it's like it's a liability that we are considering, for example, to understand this in a better way, right? So when you purchase something on credit, so it means you are entitled to pay the consideration of that security to the seller, because the seller, the that transfer that securities to you, or they will transfer the securities to you. So it means this accounting entry will be passed. Okay, so on a settlement date, what would be the again another entry? Here this entry will be processed, that the debit the payable, so this credit would be here reverse, because now actually you have received the cash, the debit, the payable account debit to cash means that we'll have to process that cash to the seller. Okay, so why this is happening, why these two entries are happening? Because most of the time we have seen that everything happen on trade date. Everything, the securities will be received, the cash will be processed, everything will happen on trade date. Then why we are creating two different accounting entries, right? So we should have a question that, okay, so again, so there was big argument on this particular part, that if we are transferring everything, we are purchasing on cash, everything we are doing at same day, then why we are creating two different accounting entries? But again, so there would sometime you may expect the process like the broker actually sending the instructions, and he just blocking that funds in your account only, and once the security is received to you, and then only the broker is releasing the funds from your account. So this might happening at somewhere, and that is what they are processing two different accounting entries, just to avoid the potential risk. Because sometime you may have heard or seen the examples like counterparty may default on a cash payment, or either maybe on a securities payment. So in that case, your contracts or the particular trades might be failed or cancelled due to this. And if you want to avoid this, so you will have to protect, you will have to first of all, so you cannot transfer all the amount to the counterparty. So you will have to actually send the instructions to the custodian and ask them to confirm it. And if they confirm yes, the securities are available for a transfer, then only the broker can release the funds from your account. And this is how the process happens. But let's see the fact. Okay. Note, subsequent measurement under accounting standard would take place where the equity security is marked to fair value but is not shown in the entries above as focus of this entries related to initial recognition. Okay. So on the other hand, if accounting is done on a settlement date basis, the accounting would be as follows. So this was this example that we have discussed about the trade date, right? Then if we follow the recognition term, then what would be, and suppose we are considering the settlement date basis, then what would be the accounting entry for a settlement date basis? Here the entry would be, see this, on a March means T plus here. On trade date there won't be any entry, but T plus 2 there would be entry. Investment in equity securities, this, and the loss which will be around the 20, because price was changed by 25, so that's 25,000, $250,000 would be here as a loss. The investment in equities account debit as usual. The loss on the securities, this, because on a trade date the price was different, at the time of settlement the price was different, so it will reflect the loss in your account, right? So that is what they will add, the loss into your account, and the total cash that it was gone from your account, which is 60 lakh. This is how, when we prepare the accounting entry on a settlement date, it will have this accounting entry. So the obvious question that arises under US GAAP, should investment be accounted for on a traded basis or settlement date basis? Well, for a general industries, US GAAP does not specify whether the trade date or a settlement date is required as such. This is an important for the discussion, because I'm concluding this. If it is required to follow the settlement date basis or traded basis or not. But what the US GAAP says, it is does not specify anything as such, which is required. An entity should be elect an accounting policy to account for a purchases and sales of securities on a trade date or settlement date basis. So while selecting or while preparing the financial statements, So they can elect. So it means they have options whether they can follow the trade date or settlement date. And once they follow, then they will have to continue that. That's it. But US GAAP does provide specific guidance for a financial institution. For a depository and lending institution, this is again important for us because we work with the depositories or lending institution. So these are the accounting standards. Accounting standards 942, 325, 252 indicates that the regular way purchases and sales of securities shall be recorded on a trade date. Very, very important. So here, so it means you can follow this technique, and even you can for interview as well. So you may expect question on this, so you can carry this particular information with you, and even you can provide them a reference as well about the accounting standards. Okay, gain and losses from a regular way security sales or disposal shall be recognized as a trade date. In the statement of operations for the period in which the securities are sold or otherwise disposed of. Okay, so the above section was for lender and the depository. This one is for brokers and dealers. Accounting standard is this: indicate that statement of a financial condition shall reflect all regular way trades on an accrual or a traded basis. For a broker, the accounting entry will be on an accrual or traded basis. Risk, benefits, and economic potentials are created and conveyed at the trade date, and that is the inception of the contract, which is when the major terms have been agreed to by the parties to properly reflect the economic effects of a purchase and the sell transactions for a financial instrument, that is to reflect the assumption of the risk and rewards resulting from the changes in the value of a financial instrument. Broker dealer shall account for the changes in the value relating to all the proprietary or financial transactions on a traded basis. So as we discuss, for a broker and dealer, so that is what they follow the traded basis, because just to avoid the risk from the transaction. If you don't have received the securities from the counterparty and you have processed the payment, and after processing the payment to the counterparty, the counterparty is denying to process that, or the securities are not available in the demat account of the particular counterparty, then what happen in that case? Then how can you avoid the risk? That is what, to process something on a trade date, it means it's just an initial stage of a particular contract, but after that there would be other procedures as well, that the processing of securities or transfer of securities from one account to other, that is what it is required time frame is t plus 2 on a t plus 2 days basis. So the securities actually will be transferred, or even you can say like it will confirm to the counterparty that, so that you have processed the securities to the counterpart, and even the cash has been debited or processed to the counterparty successfully, and that is how that transactions will be executed, and you can then pass the this accounting entry, this. Okay, and for again another is for investment companies. Accounting standard is this. You can keep this in mind, or you can write it down somewhere for your future references, so you can search this information by this particular accounting standard as well. An investment company shall record security purchases and sales as of the trade date. Again, so everyone is recording the accounting entries on a traded basis only. Agrees to purchase or sell the security, so that the effect of a all securities trades entered into by or for the account of the investment company to the date of a financial report are included in the financial report. This is very important. So it means all the market participants, they are following this, accounting standards and preparing the accounting entries. And I hope here you at this point of time, so you would have this idea. So what, accounting standards that we are referring to prepare the accounting entries, and what would be the accounting entry for a trade date, and what would be the accounting entry for a settlement date. Okay, so those the depository and lending finance institution as well as a broker and dealer in the securities and investment companies are required to record securities on a regular way on a trade day basis. Important one. And if you are interested in, okay, so this is something for our course. Okay, so here we are done with this. So the important is this entry, you can write it down somewhere, and when someone asks about what would be entry on a settlement date and what would be entry on a trade date, so you can, provide this reference as well. But if the interviewers, if the panel, they are not agreeing to a statement, so you can refer these terms as well. This is depends whether if the company want to prepare the accounting entries on the settlement date basis or on the even trade date. And if the settlement date basis, so you again you will have to keep this in mind, this entry as well. Security debit loss, or uh, depends if it is in a profit, then you may write here as well profit if it is a profit and total cash. Okay. Okay, then we are done with this, and I'm sure once you've gone through this session, you will have a good understanding about the trade date versus settlement date. I'll provide the link for the material as well, so you can, download this PDF and you can keep this with you for a future reference as well. So yeah, so we'll stay here then, and yes, bye till now, bye, enjoy it. Yes.